Hi, everyone. Welcome to the Small Cap Discoveries. We're going to be doing a little bit of an educational seminar here on taking companies private. We're going to just be really trying to focus in on talking about a framework for valuation analysis. And Paul, why don't you just explain, why we're looking at some of these microcaps this way?
Well, I think there's a number of companies in this environment right now that we think are extremely cheap. But there's a sort of a neat way to understand and sort of build conviction on the valuation of these businesses right now. And the way some people do it is a framework that's used by private equity and acquirers. So individuals or groups will look at buying a company, but they look for certain things to either really determine how cheap the business is, or more importantly, how they can also finance the acquisition of these businesses. So that's kind of what we're trying to break down here is by looking at these businesses, does this company look like it's either a takeover target, maybe a company that the management team wants to take private, and we'll give you some reasons why we think there's even more reasons why that's likely to happen in this environment. But the key here is to really understand, what makes it attractive and what could be the driver for these companies to either get taken over or, like I said, perhaps taken private by a management team. So we'll walk through, and I'm sure it'll become a little clearer as what we're talking about. But this is a typical format that's used by a lot of private equity operations.
Yeah, and we've tried to keep things as simple as possible here.
Yeah, and what I'll state again is, I mean, this is really as an exercise as investors. We're not, going to actually take over a company. So there's practicalities. There's certain things that would still have to be done to make this all work. But as investors who are looking to buy a couple percentage or maybe a couple shares of the business, taking this approach is going to help us to determine if these deals are cheap enough to own.
And the first one we're going to be talking about, which we have talked about in this format, is IBEX Technologies. IBEX trades on the TSX Venture under the symbol IBT. It's IBEX. It's a boring business. IBEX manufactures and markets proteins for biomedical use through its wholly owned subsidiary, IBEX Pharmaceuticals. It's based out of Montreal. And again, IBEX Pharmaceuticals also manufactures and markets a series of arthritis assays, which are widely used in osteoarthritis research. Paul, any comments on the company before we?
Well, let's start by saying, so it's not unusual to see private equity buying businesses that some would determine as or sort of called boring. Really, what you want to see in these type of operations is not so much what the upside is, but you want consistency, right? This is a numbers exercise. You want to make sure that the business will do at least as well as it's done in the past few years. And because there's going to be some financial sort of metrics or financial exercises here in terms of how to finance an acquisition, you really want to have the business as stable as possible. And those tend to be businesses that are somewhat boring, maybe not growing super fast, but have consistency and sort of staying power. So this is a company that fits that bill. This company's been around for many years. It has grown its revenues over the course of time, but there is some consistency to their revenues. And that's kind of why we've used it as an example here also, because there's some things to look at that make it a little bit more attractive than some others. So we really wanted to use this as a base case to show why this exercise makes sense.
So we've pulled all of these data sets from CDAR. Just wanted to highlight that just so everybody understands what we're looking at, where we're getting the information from. So that's CDAR. So we're going to the balance sheet, and this is for the year-to-date financials. So this is the last 12 months. And the company is currently sitting with about $7.6 million in cash, and they have no debt. Company has zero outstanding debt right now. So two variables that are important for the formula we're going to be showing you as we progress here. Paul, any thoughts on this before I move to the next slide?
No, well, okay. So of course, anytime you're buying a business, You want to know what the assets and liabilities are of the business you're buying. And the more assets you have and the less liabilities, and in theory, the more valuable the business is. The kind of assets that you have and the kind of liabilities you have are going to be very important. But the fact that there's a significant amount of cash in this business and significantly lower amount of liabilities increases the attractiveness here. We'll show you why down down a few more slides. The other thing that's important here, sorry, I'll dive in here, Trev, is when you're buying a business, you want to know, what the profits, what the cash generation from that business is. Why it's really important in this case too is that because we're going to look at one avenue of how you buy these businesses, and that's going out and just like a house, you want to know what kind of revenue this business is going to generate, because you're going to go and like a house, you're going to go and get a mortgage, or you're going to lend against that property, and if there's rent coming in, that increases the ability to pay off that interest or the debt that you have. So the cash flow is going to be extremely important in determining what the value of the business is, but in the event that you're either using your own capital or using somebody else's capital, you want to know what that return on that capital is going to be. Okay, and then of course you kind of want to know what the price is, right? So if you're going to buy something, you need to know what the price is. And the beauty of public companies is you pretty well know what the price is every day, every hour, every minute, as there's a change in price. But for the sake here, again, this is to determine us as investors what we're paying for the business. And in this case, we don't really have to worry about paying a premium, which we can get into maybe another time. But in this case, if the stock is trading at 53 cents, or if the offer is 53, 54, whatever, that's kind of the price we're going to be using to determine, is this business worth purchasing, and of course, why. Okay, so let's put it all together here. There's issued and outstanding, there's 24.82 million. Price as of this morning's close, 53 cents. So we've got a market cap of roughly 13 million. We'll use the number 13 million. Company has cash of 7.6 million and zero debt. Okay. From the statements, financial statements, we've got the cash flow from operations of 3.58 million. There is CapEx, so that's to replace any machinery or anything that needs to be replaced on a regular basis. So the actual free cash flow is about 3.4 million. Okay, now this is really important because this is the cash that the business has generated over the last 12 months. And if it's a stable business, we hope that at the very least we're going to see that kind of cash flow on a go-forward basis. Okay. Now, the assumptions we're going to make is what our cost of capital is. So if we're going to borrow any money to purchase this, we want to know what our interest costs are going to be. So we made the assumption of 10%. That's probably a little bit high, but let's use something conservative. If you were able to borrow against a piece of real estate, you're probably going to pay 6%. So we felt that 10% was, sort of padded enough that we feel comfortable with that. So again, the acquisition cost, based on today's trading price of 53 cents. The acquisition cost here would be $13 million. That's the market cap. However, remember, we've got cash on the balance sheet. So if we were to assume that we purchase this business today for $13 million, we'd immediately have $7.6 million that we could put in our pocket. Or if you understand the sort of concept here, we can actually use to pay down the purchase price. So in the case of somebody who had the ability to pay the whole thing off, like if I were walking around with $13 million, I now would have $7.6 million that I could put back in my pocket for a sort of out-of-pocket price of $5.36 million. Okay, so you see the equation here: 13 million minus the 7.64 million. Now, if I were to go and borrow the excess required, so roughly that 5.36 million, the interest cost, remember at 10%, would be $536,000 a year. Okay. Now we go back to the cash flow, that free cash flow of 3.4 million. We minus the interest cost, and we are left with yearly profit before tax of 2.89 million. So what we've just done here with this exercise of going out and borrowing the money is we've purchased the business for 13 million. We had a net cost after taking out the cash, 5.36 million. We went to the bank and borrowed that money. Our interest payment of $536,000 a year is paid out. And at the end of that, we end up with $2.89 million that we can put right back into our pocket, or we can use to pay down that debt that we incurred to purchase this. This is where it gets real interesting, because that return is massive, right? So we've literally put zero money down in the exercise here where we've borrowed money, and we've managed to put at the end of the year $2.89 million back into our pocket. So if you were to look at it from a levered basis, after paying the interest, this levered cash flow is 2.89 million on the 5.36 million that we borrowed, which is 54% return. Okay. Now, in reality, it's an infinite return because we didn't put any money down. Okay. If we were to purchase the whole thing outright ourselves, then of course we don't have the interest costs. We're out of pocket 5.36 million, but we've gotten at the end of the year a pre-tax return of 3.46 million, 3.43 million, which is 64% return on that 5.36 that we paid out of pocket. Now, what we're not factoring in here in either example is the tax consequences. Of course, if you're borrowing money, that interest is a taxable or tax deductible expense. And therefore, on an after-tax basis, there's some changes in those numbers, but we're trying to keep it a little simple and not really including any of the tax benefits from doing this. But this is standard sort of leverage or levered buyouts, uses this type of methodology to accomplish what they're doing. So really, from what we've seen here, is if you were able to do this, again, there's a practicality that comes into play, but if you were able to buy this business, the whole business at 53 cents under these circumstances, you could literally do it without putting a dollar down. Okay. Remember, I think I covered most of this. Did I miss anything here?
No, I think you covered it all. And
Okay,
yeah,
perfect.
really the simplicity of it is, really being able to buy a business where the debt is covered, like fully funded by the operations. And if you are able to borrow that capital to go buy the business, you're going to end up with this enterprise for free once that debt is effectively paid off.
Yeah.
So it's just a remarkable framework for looking through the microcap marketplace to look for value from a different, standpoint. Because if guys like Paul and myself are doing this, surely there's some larger animals that are doing the same thing, along with other companies and different pools of capital. So it gives us a little bit of security and in sort of the downside protection, at least, in our minds. And what's really unique about the public markets is we're able to buy a piece of the company. Well, this is a simplified, example, and may not be, practical because it might, we might need shareholder approval and there's other costs that go into actually going private through a transaction. But the opportunity to be able to buy, one share in this company with this type of framework is just, it's a phenomenal, valuation framework to really look at a business.
And what I'll add as well is that there's a number of management teams that I'm sure are going through this exercise right now in looking at their business and using these type of metrics to determine if it makes sense for them to take these businesses private. If you're someone who owns, say, 10 or 15 or 20% of a business like this, the added advantage you have is that your ownership is taken out of this equation. So, if you own 20% of IBEX, for example, your cost for the whole business is going to be 80% of that 13 million because you've already owned 20%. So the incentive is significantly higher for someone who already owns a piece, but the math is exactly the same. And yes, it may not be practical to think as an investor that, hey, I can only afford to buy 5,000 shares. So why does it matter? Why it should matter is because the likelihood of something happening when valuations are this low significantly increase. So if you're buying these type of opportunities that are out there, your odds of something getting triggered, management buyout or a takeover, are pretty high. Like, it's quite likely that something's going to happen at some point with one of these type of deals. So that's the reason you want to take this a little bit more seriously, is because, again, you may not be able to be in a position to buy the whole company, but somebody else may, and the math doesn't change whether you're a small shareholder or a large shareholder.
And Paul, while we're highlighting, this specific opportunity, I'm sure there's people sitting out there going, well, why hasn't this happened yet with this company? Or why does this opportunity exist? Like, tell us a little bit more about why, a private equity group might not have done something like this with this specific company, or
so part of it could be that, well, more times than not, it's because of the size, right? So an entity like this, 13 million, maybe $15 million purchase, believe it or not, those are way too small for a lot of the true private equity that's out there. Yes, there's one-offs, and companies like Constellation Software buy companies of this size all the time. So there's certainly players that come down here, but it's somewhat a little bit rare at this size. And part of it too is because private equity has made so much money, and there's so much money circling, that they need bigger deals to move the needle. There's a colleague that I know. He operates a private equity fund, and he won't look at anything that doesn't generate at least $10 billion a year in EBITDA. So anything that's doing $2 or $3 million, it's far below his radar screen. So that's the reason. I mean, there's a whole bunch of other little reasons. The cost to do this can be prohibitive. But now as we're seeing, some of the inflationary costs of being public, as the prices are going up, the incentive gets a little bit, better to take these companies private. So I think, and the reason, the other reason we're bringing this up and doing this exercise is we think that the environment right now is extremely conducive to more of these deals getting done. So we think you're going to see, companies announcing that they're, either being taken over by a third party, or the insiders are looking to take these companies private. So, they I'd almost say always require a premium to execute on these sort of transactions. So if you're buying a stock here and somebody is seriously looking at taking over the business, they usually have to do it at a significant premium to get the required votes to get it accomplished. So shareholders win in that case.
Got it. Thanks, Paul. And on to the final slide. I think this slide is quite interesting because, sometimes there's actually, it's shocking, but there's, more hidden value in some of these companies than we recognize. For example, if we're looking at a company that trades at, a price to earnings of 10, and it may be extreme, but, if you're able to eliminate some of these public market costs and fees to really operating a company, it could even be cheaper than that price to earnings of 10. It could even be a price to earnings of 7 or 8. So, we really wanted to just sort of highlight some of the operating costs to being a public entity.
Yeah. So as I just mentioned, the incentives are getting a little bit larger to take some of these companies private. Keep in mind that most of the companies that are likely to get taken out like this, there's real value in these businesses. They tend to, a lot of them tend to generate pretty good cash flow. So they're profitable businesses, and they sort of have lost the real reason why they're public. Most companies go public either as an exit strategy for existing shareholders, or to raise capital. And the raising of capital, if you're a profitable company and you don't need to raise money, then you've lost a big reason why. Why you'd want to be public. So now the fees that we've highlighted here, I think a lot of people probably don't recognize that just being a public company is it's a costly endeavor, but the actual breakdown of costs that would be eliminated once the company is no longer public is significant, and it's only getting higher. So there's your incentive. Another incentive for taking these things private is because you could easily see upwards of $500,000 or more in expenses that would turn into bottom line profit. And so we've got a couple line items here just to highlight some of these things here. But every year public companies have to get their financials audited so they can get filed and reported. The fees, the audit fees over the last 2 years have skyrocketed, and it's not uncommon. At the very low end, you may be able to get a $40,000 or $50,000 audit complete now, but most of the quotes I'm seeing are closer to the $80,000 to $100,000 mark for these are very small companies getting audited. So anything that's significantly larger, you're going to be seeing significantly more in terms of fees. Any company that's got international exposure, lots of transactions, things like that, it increases the complexity of the audits. So if that disappears, all of a sudden you've got about $100,000, and it could be more, that drops right to the bottom line. The other thing is, having a public board.
And Paul, just before you go on that one, actually, it was just a little tidbit there, but yeah, it was pretty unusual this year, in particular with some of these audits as well. There was such a lack of supply of auditors and audit firms that were working around the microcaps. There was a record number of companies that failed to meet their audit requirements in time. So we saw a number of different companies halt or face penalties because they were delayed with the audit. So it's a job that nobody wants right now. Nobody wants to do it, and so the prices have gone like dramatically up over the past couple of years here. So yeah, big changes there in 2022 so far.
Exactly. Now, one of the other hidden fees a lot of people don't recognize too is that, as I was saying, public companies require board of directors, and the board of directors, depending on the sort of the framework and the style of the business, there's usually fees either in the form of options or in the form of cash, and sometimes a combination of the two. It's not unusual to see board members, a full board, costing a couple $100,000 per year in either monthly or quarterly stipends, fees for attending meetings, physical, things like transportation costs and things like that to have board meetings. So, I mean, that can be anywhere from zero in the event that directors are compensated with only with options to, it's not unusual to see a small cap company, pay out $250,000 in fees. The other big thing that's seen sort of a lot of inflationary pressure right now is D&O insurance. So directors and officers insurance. So as a public company, it's pretty crazy if you have a board that has to answer to shareholders, and the liabilities that are involved in being a board responding to shareholders. You carry insurance to cover that, and insurance costs for D&O insurance have gone significantly higher. And if it's a company that is listed in the U.S. With the significantly higher litigation that's going on in the States, it's not unusual to see D&O insurance. So this is just insurance for directors and officers exceeding $1 million. Again, if you're a small company and you go private, you don't need the same insurance. There's no outside shareholders and public shareholders to respond to, so the need for that D&O insurance is significantly lower. So that's a significant cost. And then, being public, there's sustaining fees. So, it's not free to be listed. You get fees that you have to pay on a regular basis just to be listed. So that's an ongoing annual fee that you pay, and it's based on size, and it's based on a few other things. But at a bare minimum, you're going to pay $5,000. And I'd almost say at a sort of I wouldn't say bare maximum. You can significantly go higher than 15,000, but for a small company, 5,000 to 15,000 is not unusual. Then the additional, in the case of this exercise, we did TSX fees, but every time you do something, anytime you're filing, a share option plan, if you're filing an NCIB, if you're doing a financing, anytime you're doing that, the exchange has their hands out collecting fees, and it's easy to see somewhere between a $3,000 and $50,000 set of fees that you've had to pay for that. Then, of course, being a public company, investor relations, some companies, they spend almost zero in terms of investor relations, but there's hidden costs as well. So, maybe you've hired somebody to act as investor relations. Maybe you do a couple conferences. Maybe you are, hiring a consultant to help with investor relations. So, I mean, it could easily balloon up to a couple $100,000 to have your investor relations programs set out for a year. Corporate secretaries and consultants. So, somebody has to be working with the exchange and all sort of, making sure filings are done on time, accounting, overseeing accountants, overseeing auditors. That requires a person, if not more than one person. It's not unusual to see, upwards of $100,000 in consulting and corporate secretary fees. Disclosure packages. So, every time you see a press release, that costs the company money to issue that press release. The method of distribution, if you want it to go all, throughout North America, that's more costly than just a Canadian network release. If you want to go international, if you want to cover media, if you want to cover a whole bunch of different things, the costs start to add up. So it's, almost on a bare minimum, you're going to pay a couple $1,000s per year just to put press releases out in the public. And it could easily, jump above 25,000. And then sort of lastly, I mean, there's more to it than this, but these are sort of the more obvious ones, that legals, right? So there's a whole bunch of different legal requirements in being a public company as opposed to being a private company. So there's added costs dealing with the legals with the exchange and all sorts of other entities. So easily a retainer of $5,000 per year is probably too low, but it can get to over $100,000 depending on how active you are as a public company. So we've got a range really on the low side. I think I'd be hard pressed. I think there's any company out there that's spending less than 175K as in public listing and public costs. And it's not unusual to see companies spend well over $1 million in being a public entity. So if you were to go private, those things disappear. And of course, like I said, it shoots right down to the bottom line. And if that bottom line is bigger, that makes the business more valuable. And or you can look at it that the cost of the business has gone down because of the the increase in return. So just wanted to highlight that. Again, these costs are more of an incentive. Again, if I'm an owner, a founder of a business, I own 20, 25%, whatever the percentage is, it's going to start to irk me that a good chunk of that capital that sort of disappears out there could be coming back into my pocket, and just incentivizes me or someone else a little bit more to look at going through this whole ordeal of taking the company back private.
Got it.
Did we cover it all, Trev?
I think we covered it all. Yeah, I think we got it all, Paul. So I hope everyone enjoyed this video. I hope everyone takes away from this video just a different sort of framework for valuing a business, and thinking about how other sort of market predators look at some of these companies, as opposed to just looking at some traditional financial ratios or financial metrics, and doing a comparable, looking at those financial ratios relative to the comparable. So I hope everyone enjoyed this, and Paul, I'll leave you with the closing comments there.
Yeah, like we've been saying here, I don't think too many of us are in a position to go out and buy these businesses outright, but it is a healthy exercise to understand, valuations and how others are likely to value this business, and probably more importantly, the opportunity that's out there for someone to seriously do something like this, and the potential upside investors like ourselves can have by looking at that and positioning ourselves in front of that. Watch out in the markets right now. I think we're starting to see activity that suggests we're going to see more of this. We certainly saw a couple companies put themselves up for sale this past week, a couple Canadian small caps, and I think we're going to see more of this because the numbers start to make sense. And where there's opportunities like this, there's people that are sharpening their pencils and looking to do something about it. So let's keep our eyes on the ball here, and I think we'll be able to benefit by some of these opportunities.
Got it. Thanks everyone for tuning in.
See you guys.